There used to be an old rule of thumb, and I'm not sure if it's completely valid these days, to find out, what percentage of equities you should have in your portfolio, and you would take 100 minus your age, and that should be the amount you're in equities. So as an example, let's say one person was 75 years old, they take 100 minus 75, they should only be about 25% in equities at that point, and the rest of it in cash or some vehicle, cash similarity instrument, or fixed income or something else. So equities, a much smaller percentage, and that's because there's a little bit more risk involved in holding stocks. So as I guess it all depends on how concentrated you are in equities. Nearing retirement age, you have to really consider the fact that markets are volatile, and you could be susceptible to some losses. I think as an overall approach to your investment horizon, in terms of how much time you have left before you're going to need those funds, you're going to want to have to tap those funds, and you want to make sure that they're there and not necessarily have expose yourself to so much risk that you can lose money. I mean, anybody who was near retirement age back in 2008, 2009 understands what I'm talking about here, because a lot of losses were taken around that period. That was only 13, 14 years ago. And if you have to go back out and work because you had to put off your retirement, it's not going to feel good. So, I think with 5 years ago in retirement, I think it's time to start thinking about shifting your portfolio allocations to a little bit more safer investments.